Welcome, everyone. Today, we are diving into one of the most fascinating and important parts of our economy, the stock market. We are going to break it all down in the simplest way possible so you can understand how it works, why it matters, and maybe even get started with investing. By the end of this session, you will have a good grasp on how the stock market works and why people invest. If you have ever wondered how some people grow their wealth through the stock market, you are in the right place. Stick with me and we will make sense of all of it together. Imagine being able to own just a small piece of a big, successful company. That is exactly what the stock market allows you to do. Instead of needing millions of dollars to buy an entire business, you can buy just a tiny part of it. Let us break it down from the basics. What is the stock market? Imagine a huge marketplace, but instead of people trading fruits or vegetables, they are trading pieces of companies. Every time someone buys a stock, they are actually buying a little slice of that company. When you hear people say they own shares of a company, what they mean is they own a part of that business. It is like owning a very small slice of a giant pizza. The more shares you own, the bigger the slice of the company you have. Now, let us talk about chart patterns, which can help you understand how the price of a stock might move. Chart patterns are visual shapes on a graph that give hints about what could happen next. Think of them like clues that help you figure out what other investors are thinking and doing. They can help you decide whether the price of a stock might go up, down, or stay about the same. One common pattern is called the head and shoulders. Imagine three peaks in a row, like small hills. The middle peak is the highest, and the other two are a little shorter. When you see this shape, it can mean that the price might start going down soon. It is like a signal that the stock might be getting weaker, and it could be time to think about selling. Another pattern is the cup and handle, which looks just like a teacup. First, the price dips down and then slowly rises back up, forming a rounded shape like a cup. After that, there is a smaller dip, which forms the handle. This pattern often means that the price is about to go up, like the stock is getting ready for a new climb. It is a sign that people are feeling more confident about the stock. There are also patterns like triangles, which can tell you that a big move is coming, though it could go either up or down. For example, an ascending triangle has a flat top and a rising bottom. This means the price keeps pushing up, and it might break higher soon. A descending triangle has a flat bottom and a falling top, which means the stock might be getting weaker and could drop. There is also a symmetrical triangle, where the price moves into a tighter and tighter range, meaning it could soon break out in either direction. Another pattern you might see is called a double top, or a double bottom. A double top looks like the letter M and shows that the price tried to go higher twice but could not. This often means the stock might be headed lower. A double bottom looks like the letter W, meaning the price fell twice to a certain point but could not go lower, which suggests that the price might start to go up. Then there are flags and pennants. A flag looks like a small, slanted rectangle after a strong price move. It shows a short pause before the price continues in the same direction. A pennant is similar, but looks more like a small triangle. Both of these patterns mean that the stock is taking a short break before continuing its trend. These patterns are not perfect, and they do not always predict what will happen. They are more like guides that give you a better idea of what might come next. When you combine them with other information like company news or earnings reports, you can make more informed decisions about buying or selling stocks. The more you practice looking at these patterns, the more you will start to understand how the market behaves. There are many other patterns too, like triangles, flags, and double tops. Triangles show that the price is getting ready to make a big move, either up or down. Flags are small, sloping rectangles that show a pause before the price continues in the same direction. Double tops look like the letter M and suggest that the price might start falling. Learning these patterns can help you understand what other investors might be thinking and can give you an edge when you decide whether to buy or sell. It is important to remember that chart patterns are not always perfect. They can give you clues, but they do not guarantee what will happen. Many investors use them along with other information, like company earnings or news, to make better decisions. The more you practice recognizing these patterns, the better you will get at understanding the market. So, how does this all work? When you own stock in a company, you share in both its successes and its failures. If the company does well, like if they are making good profits or launching great products, the value of the company goes up. That means your little slice of that company becomes more valuable. You could sell your stock for more than you bought it, and that is how you make a profit. But on the other hand, if the company struggles, the value goes down, and so does the price of your stock. You could end up selling it for less than what you paid if things do not go well. You might wonder why the stock market even exists. Well, it serves two important purposes. First, it allows companies to raise money. Companies need money to grow, to build new products, and to expand. By selling shares to people, they get that money. Second, it gives investors, people like you and me, a chance to grow our money. We invest in the companies we believe in, and when those companies succeed, we can succeed too. When done right, it is a win for both sides. Let us talk about what exactly a stock is. A stock is a share of ownership in a company. When you buy a stock, you own a part of that company, even if it is a tiny part. Now the price of a stock changes based on something simple: supply and demand. If lots of people want to buy a stock, the price goes up. If more people want to sell it, the price goes down. It is really that simple. Sometimes companies even pay their shareholders something called a dividend, which is like a small bonus for owning the stock. Not every company does this, but it can be a nice little extra on top of any profits you make if the stock price goes up. Now let us expand on some chart patterns that traders use to analyze stocks. Chart patterns are a key part of technical analysis, and they help traders predict future price movements by looking at historical price action. One very popular pattern is the head and shoulders A pattern, which indicates a possible reversal in the trend of a stock. This pattern consists of three peaks. The first and third are smaller, and the middle peak is the highest. If you see this pattern, it might mean the price is getting ready to drop, signaling a good time to sell or avoid buying. Another pattern is the double top and double bottom. A double top looks like the letter M and suggests that a stock may be heading lower after reaching two highs. A double bottom looks like the letter W and suggests that the stock price might start to rise after reaching two lows. These patterns are useful because they show areas where the stock price has struggled to go higher or lower, indicating potential changes in direction. Then there are continuation patterns like flags and pennants. A flag forms when the price moves sharply in one direction, then moves in a smaller, sideways pattern. This often suggests that the stock price will continue in the original direction after the flag pattern is completed. A pennant is similar, but has converging trend lines that form a triangle-like shape. Both of these patterns show a brief pause before the stock continues in the same direction. Triangles are also very important patterns. There are three types: ascending, descending, and symmetrical triangles. An ascending triangle has a flat top and an upward sloping bottom, suggesting that buyers are getting stronger and a breakout to the upside is likely. A descending triangle has a flat bottom and a downward sloping top, which indicates that sellers are getting stronger and the price may break lower. A symmetrical triangle has both upward and downward sloping trend lines that converge, indicating that the price could break out in either direction, depending on the pressure from buyers or sellers. Finally, the cup and handle is a pattern that resembles the shape of a teacup. It starts with a rounded bottom, the cup, followed by a smaller dip, the handle. This pattern often indicates a bullish continuation, meaning that the price may continue to rise after the handle forms. Learning these patterns can help you make more informed decisions, but it is important to remember that no pattern is perfect. They are tools that can give you an idea of what might happen next, but they are not guarantees. It is always good to use other information like earnings reports, news, and overall market trends in combination with chart patterns to get the full picture. The more you practice spotting these patterns, the better you will get at using them to guide your investing and trading decisions. So, where does all this buying and selling actually happen? Stocks are traded on stock exchanges. These exchanges are like the meeting places where all the trading happens. You might have heard of some famous exchanges like the New York Stock Exchange or NASDAQ. These are some of the most important stock exchanges where people come together to buy and sell stocks. And then there are stock indexes. You might have heard of the S&P 500 or the Dow Jones Industrial Average. These indexes track groups of stocks to give us an idea of how the market is doing overall. The S&P 500, for example, tracks the biggest 500 companies in the United States. If the S&P 500 is doing well, it means most of the big companies are doing well too. Now let us dig a little deeper into why stock prices go up and down. Like I said before, the main reason is supply and demand. But what drives that demand? A big factor is how the company itself is doing. If a company has a great earnings report or launches a popular new product, investors might see that as a sign of future growth. That gets people excited and more people want to buy the stock, which makes the price go up. But it is not just about the company. Sometimes stock prices change because of how investors are feeling about the economy in general. If people are feeling optimistic about the future, prices tend to rise. If people are nervous or unsure, prices might fall, even if the company itself has not changed. Speaking of different types of investors, there are a couple different ways to approach investing in the stock market. Some people are long-term investors. They buy stocks with the idea of holding them for many years, maybe even decades. They are not worried about day-to-day price changes. They are looking for the company to grow steadily over time. On the other hand, there are short-term traders. You may have heard of day traders or swing traders. These people buy and sell stocks quickly, sometimes within a day or a week, trying to make money from small price movements. It is a faster-paced way to invest, but it can also be riskier. Short-term traders often use chart patterns to help them make decisions. These traders rely heavily on recognizing formations like head and shoulders, double tops and bottoms, flags, pennants, and triangles. For example, they may use a head and shoulders pattern to predict that a stock's price is about to decline, allowing them to profit by selling before the drop. Day traders are always on the lookout for these signals to find opportunities where they can buy low and sell high within short time frames. Similarly, swing traders use continuation patterns like flags and pennants to determine when a price might keep moving in its current direction, allowing them to ride the wave for a few days or weeks. If you are just starting out, long-term investing is often a good choice. It gives you time to learn how the market works without the pressure of trying to time every small movement. Long-term investors are more focused on the overall growth and health of the companies they invest in, and they are less concerned with short-term volatility. Instead of relying on daily price movements, they pay attention to a company's fundamentals, such as its earnings, market position, and long-term potential for growth. This approach is generally considered less risky and can be a great way to build wealth over time. Of course, investing in the stock market is not without its risks. You can make money, but you can also lose money. The biggest reward of the stock market is the potential to grow your wealth over time. Historically, the stock market has done better than other types of investments, like savings accounts or bonds. But there are no guarantees. If a company you invest in does not do well, or if the entire market takes a downturn, you could see a drop in your investments. This is why managing risk is so important. One of the best ways to do this is by diversifying your investments. This means not putting all your money into one single stock. Spread your investments across different companies and industries. This way, if one stock does not perform well, your other investments might do better and help balance things out. Now, if you are ready to get started, the first thing you will need is a brokerage account. A brokerage account is a special type of account that allows you to buy and sell stocks. It is like a bank account, but for investing. There are lots of online brokers that make opening an account really easy. Once you have a brokerage account, you can start buying stocks. But before you jump in, it is important to do some research. Look at how a company is doing, how long it has been around, and whether it is in a growing industry. Doing your homework before buying a stock helps you make informed decisions. And if you are new, it is okay to start small. You do not need a lot of money to start investing. It is better to learn with a small amount, get comfortable with how everything works, and build your confidence. Remember, the goal is to learn and grow your wealth over time, not to get rich overnight. There are also some common mistakes that many beginners make when they start investing. One mistake is chasing after the hottest stocks. Just because a stock is going up quickly does not mean it will keep going up. Always make sure to do your research before buying. Another common mistake is misunderstanding chart patterns. Beginners might see a pattern like a head and shoulders or a double top and immediately jump to conclusions without considering the bigger picture. Remember, chart patterns are only clues and not guarantees. It is important to understand the context of the market and to combine chart analysis with other information, such as news and company performance. Another mistake is putting all your money into just one stock. That is risky because if that one stock drops, you could lose a lot of money. Remember, diversification is key. A big mistake is also failing to recognize false breakouts. Sometimes a stock's price may seem to be breaking out of a pattern, only to quickly reverse direction. This is known as a false breakout. It is important to be patient and wait for confirmation of a breakout before making a decision. Practicing caution can help you avoid making impulsive decisions. And lastly, avoid trying to time the market. Some people try to buy at the perfect time and sell at the perfect time, but this is almost impossible to do consistently. It is much better to focus on long-term growth rather than trying to get every buy and sell exactly right. Here are a few practical tips that might help you as you learn about the stock market. One of the easiest ways to start investing is by putting your money into index funds. Index funds allow you to invest in a large group of stocks all at once, which helps you diversify your investments without having to pick individual companies. This is great for beginners because it reduces your risk and makes investing easier. Another good habit is following financial news. Staying informed about what is happening with different companies and in the economy will help you understand why the market moves the way it does. And finally, be patient. The stock market rewards those who are willing to stick with it over time. It is normal for prices to go up and down in the short term, but over the long term, the market tends to grow. Staying patient and focused on your goals is the key to success. All right, let us quickly recap what we have learned today. The stock market is where people buy and sell ownership in companies. When you buy a stock, you own a small part of that company. The goal for most investors is to grow their wealth over time, and while there are risks involved, these risks can be managed by diversifying and staying informed. There are different ways to invest, from long-term investing to short-term trading. For most beginners, starting with long-term investments in index funds and building knowledge gradually is a smart way to begin. And remember, understanding the stock market, it does not have to be complicated. With a little bit of research, patience, and practice, you can make smart decisions and grow your wealth over time. If you have any questions or thoughts, feel free to share. Let us keep learning together and stay patient as we work towards our financial goals. Thank you for joining me today and happy investing.